Hello, everyone, and welcome to this afternoon webinar. How are you guys doing today? Is everyone all right? You can use the chat to communicate with myself and, of course, with Jens when he joins us in a second. I just started this webinar a bit earlier. Jens. Hello, Jens.
Hello, Theo.
How are you doing, my friend?
I'm doing great. How are you doing?
I'm doing great too.
So I just heard you're bearish on the pound.
You hear everything, huh?
Yes.
I just asked who is trading on what they are trading, and looks like everyone is dumping the pound.
Yeah, very interesting. I think it's perfect for today's topic and in regards to inflation due to the numbers we've seen in the morning. I think came in below expectations and making a more dovish.
Combining with the retracement that follows until we see the interest rates next week. What they're gonna, I think it's next week, the interest rates on the UK. So we see what's gonna be there, and Jens, if you don't mind just for 1 second to share my screen, because we have the next market talk series, and I would like to make sure everyone is aware, guys, on July 27.
With Wieland, that's nice.
Yes, with Wieland.
Yeah, I did. At once I did a podcast with him. It's several years ago, but I know him. He's a nice guy.
I did a podcast with him. He invited me. I think it was just after I got my CFT's certificate, and it was maybe 1 month ago or 3 weeks ago. So he's an incredible gentleman and very knowledgeable in the field. And guys, I will share the link with you. Please make sure you register for this webinar with Wieland. It's more about technical analysis and market and psychology of traders. So it's an unbelievable webinar that will be. So I'm looking forward to. So Jens, I think you can share your screen when you're ready.
Yes, let me do this. 1 sec. So there we go. Can you see it?
Yes. Yep.
Beautiful.
Inflation.
So let me just type in hello traders into the chat box. This is where you can ask all your questions. There we go. There's the first question. I think it's for you. It's on the event with Wieland. Is it going to be recorded? I think so. No?
Yes, I will answer live. It will going to be recorded, of course, like all the webinars. By the way, because I don't know if you guys asked, from those who ask anyway, the last webinar, it was with John Bollinger, and the team the team hasn't uploaded yet on the YouTube channel. So please make sure you not only subscribe on the YouTube, but enable your notifications so you will receive notification when they will upload it with John Bollinger. So yeah, everything is recorded. Even this webinar is recorded, guys, and you can rewatch it later. Yes.
Yeah, you can carefully study it and then tell me I was wrong on pound sterling.
You are right. Jens is always right.
Yes, tell this my wife. So
okay. All right. So I wish you good luck and everyone to enjoy the webinar.
Thanks a lot, Theo. So talk to you, I think, on Friday again, right? So today is Wednesday, so it's a little unusual, let's say, but we switched together with Paul, and so it's not just today, but we will see each other again on Friday. I really look forward to it.
Perfect.
Great, Theo. See you then.
See you.
So yeah, guys, let's start. Let's have a look at today's topic. In regards to inflation, I already mentioned it. Numbers around inflation came in today for the UK and had an impact on pound sterling. Probably it makes sense to also review the chart. But also, in addition to that, we also want to have a look at the inflation data from last week already. in regards to the Fed, respectively, the US dollar, and the US inflation came in below expectations. It surprised me. To be honest, I was like, I was already surprised before the data was released last week on Wednesday. I was surprised to see that expectations were around 3% year on year. Just remember that 1 year ago, at this exact time, we were talking about inflation rate being at 9.1%. So year on year in this regard, and now from there it really collapsed, came down, mostly certainly due to the Fed hiking aggressively rates, but in addition to that also we've seen this drop in inflation due to the drop in fuel especially, but also food prices coming down. Still the core inflation is elevated, came in at a 4.8%, if I'm not mistaken. And that's definitely something to keep an eye on and keep in mind, especially when looking now 1 week ahead. Next week on Wednesday, we have the Fed with the next rate decision, and you will see within the Fed Watch tool that the market is currently pricing in another 25 basis point rate hike by next week with a probability of 100%. So the market is expecting the Fed will hike rates. But what's more interesting is not if the Fed will hike or not. I think she will, but what we'll see after that. And that depends mainly on the overall inflation outlook. But before we start and get into the action, first of all, please make sure that you read carefully the risk disclaimer, that you understand that trading involves risk, especially trading leveraged products like CFDs, FX, and that this may not be suitable for all investors, that you understand all risks involved, that you please consult an independent advisor, probably financial advisor, to find out whether this product is suitable for your or based on your personal risk profile, and then download the demo at admiralmarkets.com. Test your skill, your knowledge in simulated environment, and then take it from there. In addition to that, please make sure that you understand that everything I present to you today, all thoughts are purely educational and purely informational, but it's not financial advice in any way. So please make sure that you only take my thoughts as some hints, and then think yourself about this and that asset, this and that picture, draw your own conclusions and make your own decisions. And again, purely educational, purely informational. I think I don't need to introduce Admirals any further as a broker, which is in the financial industry for over 20 years now, and fully regulated, SISIC regulated, FCA regulated, ASIC regulated, also overseen the business from a regulatory authority in Jordan. That's the word. That was the word. And a very competitive offering when it comes to DAX trading over here. Usually we refer in Germany as the DAX expert when it comes to trading, especially the DAX. So one word, one broker. Check out admiralmarkets.com for further details. And so what we want to do now is we want to, first of all, dig deeper into the topic of inflation from a purely theoretical standpoint. And then once we are all on the same page, we want to jump into the charts and put the recent inflation data a little into perspective. Also understanding probably why currently, especially, the outlook for gold is very bullish despite inflation coming down. So you probably have heard about this saying that market participants say that gold is an inflation hedge. It's not. Okay, long thing short, no, it's not. The correlation with inflation results especially out of the anticipation of a rate hike cycle, which is about to end, and then the Fed, in this case, cutting rates, in fact. So and inflation runs hot and the central bank starts to hike aggressively rates, then usually you see gold dropping in price due to the fact that gold does not pay any yields. And once inflation, let's say, is back under control, what you usually see is the Fed then cutting rates. And this, at least in the last 20 years, corresponds with massive runs higher. And we are in a very, very interesting environment, because with the Fed next week, you will probably wonder, well, are we now done on the upside? And this is exactly where the interesting part starts. What will the Fed tell us? 5 weeks ago, the last Fed meeting, the Fed was saying, well, and that was surprising, saying that we see another 50 basis points higher interest rates at the end of the year 2023. And that surprised market participants, because till then we expected the target rates to be at 500 to 525 basis points. And now there's another 25 and then another 25. The market is expecting 25, but not more than that. And if this finds itself within the communication from the Fed, that could be the sign that we then see at least a pause and cuts from the first half, or with the start, let's say, of 2024. And this is then ultra bullish, at least historically, going back till 2000 around. So at least the 20-25 years. You can check this out yourself. Just check a website where you can find the rate cycle, and then overlay this with the gold chart. Make sure that the axes correspond with each other, and you will see that gold on average something like pushed higher once the rate hike cycle ended, of around, was a bullish performance of 150 to 200%. In each case, I think there was 3 or 4 rate cut cycles, in this case, rate hike and then rate cut cycles. And the interesting thing about this is that this window usually opened then for something like 5 to 6 years, which is very interesting because this is a longer perspective. This is more like kind of an investment play. But the question you might have right now is what or where are the best risk reward opportunities in the current environment? For example, when looking at the current run higher in equity indices like Nasdaq pushing higher up to 16,000, breaking above the March-April 2022 highs. The current region to look for when it comes to the S&P 500, for example, also 4,600 points on the upside, really nearly going vertical. And so some might probably say, well, we've run quite a bit. So if you didn't anticipate this and let's say followed the clear signs, I think there were clear signs that we were done around October, November 2022, after the bear market over the course of the whole year 2022. And then we started to consolidate, especially in stocks which are currently running really, really hot and have potential on the upside, continuously potential on the upside. I think like a Tesla, for example. If you didn't scale into a trade, then over the course of the first 3-4 months of the year, I think you nearly missed out on the first opportunity. Let's see how Tesla earnings, for example, come out. But right now, I think risk reward wise, at least when it comes to the overall market, let's see how things play out. I was also skeptical in terms of Nvidia, and then we saw this massive gap higher at the end of May. Didn't see that coming, and also there was not even there wasn't even market participants trying to close the gap, but we just held and then pushed higher from there. Now the company has a market cap as the first semiconductor company of 1 trillion right now, and holding these highs because the demand is, and Nvidia is the leader in this space. Also something to probably re-watch. Last year I was painting a very positive picture for Nvidia. Unfortunately, I didn't find an entry, in fact. So I wasn't buying the dip or the losses or the push lower. That's probably the best way to put it, over the course of 2022. And then I was like, at the beginning of, I think it was February or something, I was like, okay, now a pull in. We've already run up something like 70% or so from the 2022 lows, and then there was no pull in. There was a bullish consolidation, and then we just pushed higher. And I was like, okay, now we're probably a little extended. Let's see whether we probably come in. Last earnings release, 25% higher. So like it really ran away from me. And while I still think it's a leader in the space, and I think we have plenty more room to go, and I think we haven't yet seen the highs around the market cap, let's say, I would say the current mode is too extreme on the upside. Brings us back to the question, what's currently interesting in the current environment in terms of risk reward and potential trade or investment ideas, probably for a longer time frame. And I think gold, but also mining stocks like Barrick Gold, probably Newmont, are probably interesting, at least. So give it a deeper look. I think we are potentially headed higher, but we look at gold at a later point in this presentation. First of all, again, what is inflation? To be on the same page here. So in economics, inflation is a general increase in the prices of goods and services in an economy. So you see rising prices. So when the general price level rises, each unit of currency buys fewer goods and services. So this is how inflation is defined. And that being said, inflation erodes the purchasing power of a bond's futures cash flow. So simply speaking, the higher the current rate of inflation, then the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand this higher yield to compensate for inflation risks. This is long things short, in fact. And we've seen inflation getting out of control. You probably recall this, let's call it chain. We made a topic around the employment situation and how strong employment numbers, lower unemployment rates points to a quite strong economic environment in general, which means that companies are paying higher salaries, higher wages, which means people have more money to spend, which drives prices higher. This is the, let's call it natural and the healthy development in terms of inflation, how we get to higher levels of inflation. It's due to strong economic growth and demand from consumers. The current environment, or at least the environment we've seen over the course of, let's say, the last 1.5, 2 years, and the explosion higher, that wasn't due to economic growth. That was due to the fact that people were locked down at home, forced to stay at home due to a pandemic, and the central bank / governments around the globe, they just thought, well, if you pay the people enough money, or if you pay them something, let's say, they will likelier stay home. So that's how I interpret and see this whole situation, to be honest. And that was exactly what we got to see. So there you interrupt the supply chains. You make sure, that's a difficult way to say that, but it's like, yeah, you not just interrupt the supply chains, but you're also interrupting the overall economic production in general, while you're flooding markets with liquidity, handing out stimulus checks to people so that they stay home. So there's more money now chasing fewer goods once you revive the economy, or once you reopen the economy, and if you let people out again. And the lesser money, the lesser goods are chased from lots of money, which is driving prices higher. And we've seen that coming. It was very interesting to see that all these, let's call them experts, especially here in Germany. So you have to really laugh at them really hard, because these guys are sitting in front of a TV camera and telling you, well, I don't see any risks of inflation rising. That was in summer 2021. And you were just shaking your head in disbelief. If you have someone, if you're self-employed, if you're working in the manufacturing business, whatever, you just see, well, prices are rising. So you have to pay enormously more compared to 1 year ago, for example, for wood. For example, if you're building a house, let's say, or something like that, you can see that. If you're a painter or something like that, you have to pay more for the color, because there are disruptions in the supply chains. You see the same when it comes to buying cars or something like that. It perfectly makes sense. And the expert is sitting there, well, say, I have a PhD in economics, and I tell you, no, inflation is not an issue. Half a year later, you see prices exploding. You could already seen that coming. If you went to whatever store to buy, let's say, something like wood or pain or whatever it might be, and the prices were already rising, and it was just a question of time once you see this push higher in inflation, or in prices, and thus inflation picking up. It was just a question of time once it would hit the small consumer, and especially when it comes to food. And in addition to that, there was also this explosion higher in commodity prices, for example, fuel, especially after the invasion of the Ukraine from Russia, for example. That was another catalyst, let's say, on the upside, pushing prices higher, even though when looking at inflation, it was only the last part of this. The first thing, I mean, there was the saying then in the mainstream media that we're talking about Putinflation and everything, but inflation already raged and got out of control way earlier. And I'm not really sure if you really can sell the people the story that inflation anticipated the war in the Ukraine. I don't think so. So just to put things into perspective here. And so inflation getting out of control right now. Now you want to bring it back under control. You really can't without hiking rates aggressively. In this case, it's like probably you can imagine inflation getting out of control like a bottle of ketchup, right? So you probably remember the glass bottles, and if you shake them and then you try to put some ketchup on your French fries, nothing happens. It's a glass bottle. Okay. So nothing happens, blush. And then you have just a ton of ketchup on your French fries. It's like a tomato soup. You have that. And you don't get it back into the bottle. So this is like inflation works. So it doesn't pick up, and once it picks up, it gets out of control. And that's exactly what we got to see. And as you can see here, so that's probably better, would have been better to show the chart earlier. So well, I have two charts here. So in blue, you have the inflation rate, and you have in the black dotted line, you have the producer prices. So as you can see here, there was this pickup in inflation already, and especially in producer prices. So in fact, inflation rate is lagging producer prices because producers usually feel the pressure or the heat earlier, let's say, or inflation prices are picking up earlier. And then there is a lag because the producers will forward the higher prices they have to pay for producing a good to the consumer, but this will hit the market a little later. And that's why you have this delay here in this regard. And as you can see here, so 2020, 2022, so that was around the invasion of the Ukraine, early 2022. And we saw here the pickup in prices already significantly higher, producer prices and also inflation then following. And there was this small spike here on the upside. So no chance that this has something to do with the invasion, the overall development in terms of the inflation, but at least it sells. So that's something you can tell the people. And most of the people, if they're not interested in financial markets, won't ask questions here, but just take it as it is. And if you understand and if you follow the action here very closely and follow the financial markets, follow the webinars here, for example, you're just shaking your heads in disbelief, and you can't really explain this to people. This is the next thing. So yeah, they don't want to hear this. So it's like it just doesn't make sense. The same is true, for example, when it comes to, let's say, pharma companies like Pfizer or BioNTech or Moderna or something like that, and the explosion here in their share prices on the upside. Well, it was just a conspiracy, let's say. So they got guaranteed from governments around the globe that their products, inferior products, that's something we have to say here, because these vaccines, you put this in quotation marks because, well, it was really, I'm not really sure. They were just taken and they sold them at far too high prices, inferior product, because government, in fact, paid them to sell it. So that's at least what it was, and it's not a fantastic technique or something like that, or like a blockbuster or something like that, a blockbuster vaccine. It's not. It's an inferior product. And this is how things go. And it was just about it was about the money. That's just how it is, right? So but coming back to inflation, so we see this push higher, and then we're topping out here. And as you can see, so producer prices are now significantly under pressure, and inflation is following. And we could also see this. You probably recall some charts I was showing in the recent past and further in earlier webinars here in terms of the paid prices in the ISM, for example, manufacturing, non-manufacturing. You've seen that that there was already clear signs that paid prices were dropping, and they're positively correlated to inflation, and our inflation is just lagging. So what you can clearly see here is that we are probably about to see a push below 2% quite soon, in fact, which brings us to the question, how much further room we have till the Fed will likely start to cut rates again. So in this regard, what we now have is here on the left is the Fed Watch tool. This is what the future market is expecting in terms of the target rate to be at the end of the year. You can see it here, target rate probabilities for 13th of December, 2023. And this is from today, in fact. Let me just, by the way, let me just check something here. One second. I just have to check something in the background. Yeah, that's not so cool. Okay. So very interesting. In fact, so Carvana just delivered earnings, and I'm just checking how much volume was done so far. Over 20 million shares. Looks a little extended on the upside, especially since the deal doesn't look so bullish to me. In fact, it looks like they are about to offer shares to shareholders, which means like a gap up of 40%. A company which is nearly bankrupt now found a deal on, I think, getting rid of 1.2 billion of their debt. Was about to go bankrupt, in fact, and then a gap of 40% seems a little too much for me. So it's very much likely that there's a massive short squeeze on the upside, due to the shortfall being something like 40-50% or so. However, let's come back to the presentation, and let me come here to the Fed Watch tool and share the link here so that you can check this out yourself and where I get the numbers from. We call this Fed Watch tool. So you can see it here. So it's a chart, or it's a how to interpret this. So each column, or no, it's a future market. So we are looking here at the CME. And there's not just futures being traded, but also options. And market participants, they price the option based on so-called Greeks. So you have the delta, you have the gamma, you have the rho, which is responsible for yields, for example. You have the theta, which is the time component. You have the vega, which is the volatility component. Delta is the change in price of the underlying asset, while the gamma is how can I say that? I need to find the word. The German word is erste Ableitung, but it's like a mathematical term. Let me just check this out. I'm just missing the word. 1 second. It's what do you have here? English. Okay, so every. Okay, doesn't work. What is this? Why doesn't it work? 1 second. So Google Translator. So let's see. Okay. It's German, obviously. Derivation? Not really sure. Is this right? Yeah, well, however. So it's a derivation. I hope you understand that. You get this. The first derivation of the price is the gamma. No, this is the delta, and the second is the gamma in this regard. And so very mathematical term in this regard. And what they do is in fact nothing more than especially looking at what is the market expecting in terms of the rho, and then looking at the overall market, and then using this information to derive probability that the market is currently pricing this and that level rate target here at a certain point in the future, a certain date. And this is how these columns then come into play. And as you can see here, so right now for December, 13th of December, or let's probably start with next week, July. So you can see here 99.8. That's the likelihood that next week the Fed will hike rates by another 25 basis points, which is very interesting because, again, you're fighting inflation by hiking rates bringing inflation down to your target, which is around 2%, we see that inflation has already come down massively, is about to cool down further, and the market is still expecting the Fed to hike further on the upside, which is very interesting because usually you expect the Fed now to calm down, because if you're hiking too aggressively, then the overall economy could take a hit, in fact, and slow down too, which we currently witness, to be honest. So if you look at retail sales, for example, if you look at, for example, earnings releases from Walmart or from Target, so big retailers in the US. So there's already economic headlines due to the very restrictive monetary policy path from the Fed. And so it seems surprising that the Fed here is expected to hike another 25 basis points next week. But as you can see, looking now 5 months into the future, into December, as you can see, this is then the last step, and market are now expecting the Fed to not hike further with a probability of nearly 80%. And this is the interesting thing now, because then this means nothing more than we will pause, and there's no further rate hikes to come in the near future, or in the near future, respectively. Now looking here into March 2024, for example, you can see that here the market is expecting already, with a likelihood of nearly 70%, 75%, that the target rate will be 500 to 525. So that means they pause till the end of the year. In the first quarter, they're expected to cut rates first time, and then let's just probably move on June next year. So 1 year from now, the Fed is expected, and the target rate of the Fed is to be expected at 450 to 475. So further rate cuts, then we are already talking about 3 rate cuts. So the Fed is already expected to cut rates. So we are done in terms of rate hikes. And this is then where the market in general comes into play. And let's now have a look here at the current developments. Probably start with gold, especially after the recent push higher. Again, inflation is about to come down. Okay, the market is a discounting mechanism in this regard. So that means the market is expecting inflation to come down further and the Fed to cut rates. This is the explanation why gold is breaking higher, as you can see here. That was yesterday, the push higher out of a tight consolidation higher, but also here, that was the push on inflation. Inflation comes down, you might say, well, gold is an inflation hedge. If inflation comes down, gold should sell off. No, it shouldn't, because the Fed is expected, due to inflation coming down, to cut rates. Since this is what the Fed was after in first place, and this is what's driving gold higher here, and bringing the US dollar under pressure, which has seen some massive capital inflows over the course of 2022, in fact. So we already started here around 121, that was early 21, in fact, and then we accelerated massively on the downside. Certainly over the course of year 2022, that was also due to the war in the Ukraine and everything, and especially Germany getting run over with commodity prices spiking and being very dependent on cheap Russian gas, especially. And since Germany and the German economy is the backbone of the euro, well, if you break the backbone, in this case, the German economy, well, you break the euro if you want, which is, by the way, one reason to be very skeptical of this recent rally higher. I don't think it's euro-based or euro strength, but what we get to see here is US dollar weakness, because the market is already anticipating that the Fed will cut rates, and has to cut rates. And so seeing the US dollar under pressure, knowing that gold and the US dollar are negatively correlated to each other, US dollar down, gold should go up. This is exactly the explanation for what we're currently witnessing, not just in terms of the euro, but if I want to play this US dollar weakness, I don't want to play a game here, trading a weak currency or weak expectation for the US dollar and choose a weak counterpart, or a counterpart which I'm skeptical about. But in terms of my overall expectation in the US dollar being weak, I take gold, especially since, as you can see here, gold is holding up really, really nicely and about to attack its all-time highs you can find at 2080. And that being said, is this curl up here, and especially if we can now break and hold above 1,985, 2,000, I think we are potentially about to break higher here and see a massive run higher on the upside, which is likely. And now fasten your seatbelt. So I will, within the next 5 years, I see gold going up to 4, probably even 5, 6,000 US dollar per ounce. And the reason for that is because I know of the negative, or not negative, but about the correlation if you cut rates. And what I would recommend, I haven't prepared this, unfortunately. I just realized I haven't yet, but probably I will do this for the next time. So indicators, interest rate, or countries. Let's go to the United States. Look at the interest rates. And what I would recommend is taking this chart here from Trading Economics, go back for the last 25 years, start at the beginning of 2022. Take this, make a screenshot, go over, I call this TE for Trading Economics in the chat box, and then overlay it with a chart. So snipe out the chart here. Let's go to a weekly chart or something, probably. And let's see, 1994, that's not so fortunate. Let me probably go here. It's not perfect. Unfortunately, it's not perfect. But however, you probably, well, cut it out probably here. So around there. Okay, cut it out there. Overlay the charts. And then you can make the chart more transparent here in PowerPoint. It takes a little, but you can greatly visualize how rate cut cycles affected the price of gold in the past, going back to at least 2000. And you will see that on average, the gold price pushed 150 to 170%, even 200% higher within such a rate cut cycle. And the reason I become overly interested in this current picture is because we are about to see the same in terms of the fat in the course over the course of the next 12 months. So we're right now probably already anticipating the push to new all-time highs in gold here. And then that might be the trade of the next 5 years, in fact, risk reward wise, let's say. And in addition to that, certainly there will also be an outperformance when it comes to big tech stocks, especially, and especially the leaders in their space. And that's why, for example, I'm very positive for Tesla, for example. And I could imagine that this is the start. Let me just see here when you have it. So this is NVIDIA. Let's go to a daily chart. And let's go here to, where do you have it? Tesla. There. So that this is probably also the start of another massive leg higher. So you've seen here that was there. I'm not really sure. There was a split. There was another split. Right now, as you can see here, we are attacking this trend line and we're breaking above this trend line. So here having the all-time highs and then the highs we attacked at the end of 2021. There was also this push higher here in March, April 2022. And now we are breaking this trend line. It seems we are already extended. But to be honest, I think we were massively oversold at these levels from a pure fundamental perspective, looking at the earnings multiple, for example, and how cheap Tesla was from a fundamental perspective. And again, we are here confronted with a leader in its space, so e-mobility. And I really appreciate great discussions around this topic, especially over here in Germany, because people are going crazy about a potential competitor for the backbone of the German industry, respectively economy, which is the automobile sector, Volkswagen, Daimler, what else? Daimler, Mercedes-Benz, BMW, for example. So now there's a competitor from the US coming, and we are saying, no way. We are better than that. Well, we are not. Look at the numbers, at the numbers, especially when it comes to Volkswagen. Volkswagen just has no chance as in the e-mobility area, when it comes to scaling, when it comes to profitability and everything. Whatever. And then there's another discussion going. Well, e-mobility, especially over here in Germany, we are a country which is an expert in the automobile sector, an expert when it comes to controlled, how can I say that? Burning fuel in a controlled manner. Probably that's probably a good way to put it. Engine experts probably. So and then people say, well, e-mobility doesn't make sense. Also from a pure economic environment perspective, when it comes to the question, is this really sustainable? Is it really green? Let's say that's the current topic. Well, who cares? To be honest, really, I mean that. Who cares? I think everyone is right. Everyone criticizing e-mobility from an sustainability perspective is 100% right. I'm 100% on his side. But also, as I already said at the beginning, well, if government, and this is expected, you have to listen carefully to what politicians are talking about and governments. They want this to succeed for whatever reason, and whatever agenda might be the reason for their thought process, but they want e-mobility, as they wanted the vaccines to work, and they do everything possible. And so, well, if this is then the let's say agenda for the next 5 to 10 years, well, I look for the leader in this space. I see Tesla as the leader in the space, and it's not just then. We are not only talking about e-mobility in this space, but Tesla is way more than that. Well, for example, full self-driving, one thing. You probably have seen the developments around the Cybertruck right now, which is very spacey, let's say. The developments in terms of AI, so all the developments which is then coming back to full self-driving, for example. However you put this, it's already a well-diversified company, in my personal opinion. And you also have the support from the political agenda, which is currently pushed. And that being said, should ring a bell. So this is definitely something to keep an eye on. And in addition to a very, let's call it, cheap liquidity environment, this has room to run on the upside, as has gold, for example. So that's why I'm painting a very bullish picture. And this is a longer term perspective, last 5 to 10 years probably. And let's now see how the earnings today play out. I was very surprised with the delivery numbers already. That was earlier this month. That's probably a reason to be very positive in terms of the revenue outlook. In general, EPS is definitely a topic after the price cuts, which took place earlier this year. They really we could see already the gross margin dropping in the Q1 earnings release. Now let's see how things play out in the Q2 earnings release. I think it will be especially the vision, which we will listen to in the earnings call, probably especially in terms of the full self-driving, probably also in terms of the energy packs, for example, the mega packs. However, the thing is, if you're painting a picture where you see the Fed after inflation coming down significantly, as we've seen, oh, by the way, no, let's go back here to this chart. If you see inflation coming down aggressively, which makes it likelier that the Fed will likely cut rates and be more dovish in her stance and also in her doing in the upcoming minimum 12 months. This could be the starting point of a massive rally, which makes perfect sense now to look if the market is a discounting mechanism, what it is. Well, then it makes perfect sense for the recent rally we've seen, for example, in the NASDAQ here. Higher. Let's have a look at the NASDAQ, and there's explosion higher, and we continue to push higher. So people ask me, "Hey Jens, are you short here?" And I was formulating a rug pull scenario earlier this month. You probably recall this. I mentioned this during the employment situation, non-farm payrolls earlier. Obviously, I am wrong on this rug pull scenario. I didn't see that on the push higher. We saw the push higher with the inflation data last week, and now we are running from here. But what I certainly did was that I told people who asked me, hey, when do we get to see the rug pull scenario? After we pushed higher and held last week after the CPIs, I said, well, being short in this environment is a very bad idea, because you just can get completely run over. If there is a pull-in, we will see the pull-in, and the market will clearly show, okay, we're done now, and this is the catalyst, whatever it might be, and then we are seeing a corrective move. But as long as we don't get to see this, I feel myself reminded of the run higher we've seen following the COVID pandemic, and this massive environment in which look at this. So fiscal stimulus, monetary stimulus, so rate cuts, QE, more QE from the ECB, from the BOJ, from the Bank of England, from whoever you looked at, stimulus checks, speculative access from market participants joining the party anew, let's say. So saying, well, I'm trading options and massively leverage buying out of the money calls in this and that and this and that stock, and the market is pushing higher, then running the overall market taking off. And it took till early September till we then saw a pull in, which didn't even bring us back to the recent highs where the sell-off here around the COVID pandemic started. And this is right now, look at the chart. So I'm not saying it's an equivalent, but I don't want to short this. I don't want to short this after having seen what happened in 2022. Rather sooner or later, there will be a massive pull-in. If the market really gets excessive on the upside, certainly there will be a pull-in, no question about that, but there will be clear signs. The market will show you once it's done on the upside, and then you probably should think about a very short-term short position, and then a pull-in trade, which you probably should trade very aggressively in terms of the stop, because you just don't know when buyers re-step in and push the market higher. I've seen that several times. It wasn't that I didn't take the short side. So early last week, I think I shorted 2 or 3 times. That was on Monday. I'm thinking that we're probably done on the upside now with a push lower. I was stopped 3 times on break even, and then saw the market pushing higher. And then was, okay, well, probably we're not yet done, and we're probably about to push higher. And that's the feedback from the market you should take. And then again, coming back to the explanation for this, I think it's an anticipation of a more dovish stance from the Fed. Let's see what the Fed will deliver. That's also something. Well, if the rate hike comes and there's no clear indication that they are not done, but probably there will be another 25 basis point rate hike, even though the market is underpricing that. Well, probably this is the reason for the pull-in. But let's face it. Once we've seen, that was 5 weeks ago when the Fed came out here saying, well, there's potentially 2 further 25 basis point rate hikes, even though inflation came already aggressively lower. The market rallied the next day and took out the Fed high. So that's a very strong market environment, very, very bullish, and you shouldn't fade this. So if you play the long side, if you don't feel comfortable trading the long side, I'd go for short-term momentum drive, momentum plays, probably waiting for a consolidation after a strong opening drive or something like that, tight consolidation, and then another leg into the close probably of the day. However this might play out, but really beware of short positions in this environment. It's definitely not a good idea. Inflation is coming down. The Fed is expected to cut rates. The market is a discounting mechanism, probably anticipating a more dovish stance from the Fed. And this is the most likely reason for the market here pushing higher in the current environment. Again, tech stocks, especially profiting from lower yields, like Tesla, for example, as a leader in its space, is probably very interesting for longer term investments. And again, also keep an eye on gold and the potential break to new all-time highs here. I think this is definitely worth to keep an eye on, not just for a short-term trade and momentum drive when we push to all-time highs, new all-time highs, but also for the next 5-6 years, probably, and about to see an investment shining, gold shining, why not? So that's it from my end for today. Here are the contact details from Admirals. If you have further questions, please feel free to reach out to them, ask your questions. Please, if you like what you just saw, recording on YouTube, leave a thumb up here, leave a comment if you have questions. Share your ideas and share your thoughts. Probably you completely disagree with me. Might also be. I'd be more than happy to read from you, ask your questions, answer them, and that's it. So happy trading. Watch your stops. Talk to you again then on Friday. I really look forward to it. See you. Bye-bye.